Good morning and welcome to this session of the live coaching classes conducted by the Board of Studies of the Institute of Chartered Accountants of India. Today, we are going to start a whole new topic. As you can see, we are going to discuss the Indian Contract Act 1872. Not the entire act, because you already had a lot of exposure to this law, maybe in college or when you prepared for your preliminary CPT or whatever. So the basic parts of the Indian Contract Act already over. What we are now going to see in this session or these sessions are the special contracts, the various special contracts. Now, this presumes that you are already familiar with the Indian Contract Act. Okay. Before I begin, let me wish those of you who have greeted in the morning. You got Pooja PS, Hitesh Jain, of course. Mahadev Bharadwaj is here. Pooja, Somesh, Bandreddy. Wow, Alok Chaudhary, Menka Kumari is here. And Vijay Kumar, Aman. Welcome, sir, all of you. And look forward to a great session with interaction. Now we have done with corporate laws. I don't know. I hope all the topics are over, but I am done with corporate laws. Now we are into other laws, one of which is the Indian Contract Act 1872. Wow, that's pretty. It's what, more than 150 years it's good. Yeah, 150 years now. 2022. That's more than that. We are now in 2022. It's almost 150 years of the Indian Contract Act. I think nobody is really recognizing this fact. I don't know why. 150 years is quite a long time for a law to be with us without much change. See, this law was drafted by a man not very popular in India. In fact, currently he is very unpopular in India. A man called Lord Macaulay. Indians don't like Macaulay because we blame Macaulay for many of the bad things that happened to us, including the schooling system that we've got here. Okay, the schooling system that we have in India today is a heritage of the British system, where the British did not really want Indians to think or to be very intelligent or give opinions, because we were the ruled and they were the rulers. So they were more interested in creating clerks and managers who would obey rather than whatever. But that didn't work, The fact Macaulay sowed the seed of their own destruction. What Macaulay did ultimately resulted in the creation of people like Mohandas Karamchand Gandhi, and others who used the very education that they received from the British to make them go away. Anyway, that is one thing. But then Macaulay was a great draftsman. As a draftsman, as a user of the English language, he was good. And this law survives, so many years without major amendments. There have been no major amendments to this law. When we had the Information Technology Act being enacted in 2000, we sort of made minor modifications here, but then there was no need. Macaulay had already provided for it. Macaulay lived in an era where printing had just sort of popular. Not many people could have books and writing and all that. That was very special. So in that age, Macaulay never spoke about writing. He spoke about any method in which things could be communicated. So he had already presumed the paper would be out and something else would come. That is the level at which Macaulay could think. So this particular act, the Indian Contract Act 1872, I call it a framework enactment. It's a framework. The Indian Contract Act gives the framework within which business transactions are conducted. It's a very important enactment. And what we are going to see in the coming classes are special contracts. See, normal contracts, for example, a contract for where you promise to do something and I pay you money, maybe purchase of goods, sale, etc. Of course, there's a separate enactment for that, Sale of Goods Act. The Sale of Goods Act, which I'm sure you studied it in CPT or in college. You're not going to study it again here. So whatever it is, there are contracts within these are special types of contracts. What you're going to see, you're going to talk about three special type of contracts. One is the contract of, rather we are going to talk about 4 plus 1, 5 types. We're going to talk about the contract of indemnity, the contract of guarantee, bailment, pledge, and agency. 5 types. Though indemnity and guarantee are clubbed together and bailment and pledge are clubbed together, but then they are alag. They are not the same. You're going to see the difference also, right? So we'll begin today with the contract of indemnity and guarantee. Let's first look at indemnity. Okay. Then we'll move on to the contract of guarantee, understand what it's all about. Then the nature of the liability of a person called surety. Then talk about continuing guarantees, discharge of surety, very, very important from exam point of view, and rights of the surety, right? So first, let's come to indemnity. It's a very simple topic. In fact, only two sections, if I remember right, 124 and 125. That's all. Indemnity. Indemnity means to make good the loss or to compensate the party who has suffered some loss. When I agree to indemnify you, I agree to make good the loss or to compensate the party who has suffered some loss, right? One party promises to save the other from loss caused to him. One party promises to save the other from loss caused to him by the conduct of the promisor himself or by the conduct of any other person. Conduct of the promisor himself or by the conduct of any other person. Now, simple example, and it's so easy. Physical share certificates. Okay, Mr. A is holding physical share certificates. The certificates have been lost. He wants a duplicate certificate. He goes to the company, the company which issued, and he says, I want a duplicate certificate. Now, the company is worried because it's quite possible that A has sold the shares and is coming to them. I mean, they can always check up, but then, because the transferee would have come to them for, transfer registration, but then maybe the transferee has not bothered. I know the transferor is trying to get a duplicate certificate. Now, this is not unknown. So they are worried. It is quite possible that A is an honorable man. He really lost those certificates. But it's also possible that he is cheating the company. Whatever it is, tomorrow, that if at all there is a transferee, if at all the shares have been transferred, the transferee may be affected by this. Therefore, he may sue the company for damages. Because, he's the owner. They have issued a duplicate to somebody who is not the owner. So they are worried. So they will tell Mr. A, look here, A, we believe you, but it's not enough. Give us a contract. Give us a legal document by which you promise to save us from loss caused, okay, by our conduct. Because we are now issuing you the duplicate certificate, okay, we may be affected later. There may be a case against us. You please give us an indemnity, okay, by which you promise to save us or you promise to compensate us for any loss that we might incur on account of issuing this duplicate certificate. In case there is a true owner and you already transferred it and that fellow comes to us, all we will do is point the finger at you and he has to file a suit against you for fraud, whatever. We are not affected. So this is an example of a contract of indemnity. I'm giving an example to help you understand. So in a contract of indemnity, there are two people. One is the indemnifier who promises to indemnify. To indemnify means to make good the loss. When I promise to indemnify you, I promise to compensate you or make good the loss that you have incurred. Okay, there is a well-known contract of indemnity. All of us are using it regularly. It's a service that we all enjoy. Maybe if you have a two-wheeler, you might have already entered into that contract. Okay. So contract of indemnity. Anybody can, okay, Hitesh, since you seem to be an expert in contract of indemnity, can you give me one example of a contract of very, very popular public contract of indemnity? Well known. It's a specialized area, but basically it's a contract of indemnity where there's an indemnifier and an indemnified. Beautiful. Tanya is coming out with the correct answer. Akash Neil also. Insurance is a classic example of a contract of indemnity. Insurance is a contract of indemnity. Pure and simple contract of indemnity. Consideration is the premium paid. See, the beauty is the indemnified here approaches the indemnifier and he says, cover my loss. So the indemnifier says, the insurance company says, life insurance also is a contract of indemnity. LIC. Life insurance is one example, but a better example would be general insurance. Because many life insurance products, life insurance is also a contract of indemnity. Because in the event of death, the life insurance corporation or any life insurance company for that matter promises to indemnify the survivors or the legal heirs. Any insurance, all insurance contracts are contracts of indemnity, where the insurance company is the indemnifier and the policy holder is the indemnified. So this is a simple example. The consideration for this contract is, see, you know very well, any contract there should be a consideration. You already studied in your CPT college that there are very few contracts which are exceptions to the rule where consideration is not required. Okay. In fact, these exceptions prove the rule about consideration. Okay. So contract, one of the essence of a contract is consideration. So in the case of a contract of indemnity, the consideration is the indemnifier agreeing to cover the loss of the indemnified. In the contract of insurance, the consideration is premium paid by the indemnified, the policy holder, and the promise made by the indemnifier to cover the loss or to compensate him for the specific risk covered in the insurance policy. There are specific risks, okay? Which is why contract of insurance is specialized contract of indemnity, where different types of risks are covered, different covers are there, different riders are there, different conditions are there. So many things are there. It's very complicated. But at the core of an insurance contract is the indemnity. The indemnifier is the insurance company and the indemnified is the anybody, you and I. You just go, you go to a company. See, today, you don't even have to go anywhere. You can sit at home, online, you can purchase a policy. But essentially what's happening is you are requesting the company to issue a policy. They are agreeing to indemnify you in consideration for the premium. That's how they make money. So they collect premium from a lot of people, whereas the loss is incurred only by a very few people. So this is the logic on which insurance works. I don't know how to, just to give you an example. It's a contract of indemnity. Insurance is a contract of indemnity. See, distinguish a contract of indemnity with a wager, a gambler, pure wager. See, there are two crows sitting on a fence. There are two crows sitting on a fence. You and I are standing there. I'm a gambler. So immediately I tell you, $100, the crow on the right will fly first. That's all. That's all. The bet is based on simple thing. We both are standing there on in the open place. There's a fence. Two crows are sitting on it. We are facing the crows. And I'm telling you, $100, the right hand side crow will fly first. Is this a contract of indemnity? No. This is a wagering contract. Okay? Contingent contract you can say, but wagering contract. In that sense, insurance is also a contingent contract. Because the liability of the indemnifier may or may not arise. May arise or may not arise, depending on the occurrence or non-occurrence of an event. Okay, so you have to always not confuse this with where I say if the right hand side crow flies first, I'll give you $100. It's not a contract of indemnity. It's a wagering contract. It's a gambling contract, right? Small distinction. Here, what is the basic difference? There should be an insurable interest. There should be the contract of indemnity. There should be the indemnified should be in some way affected by the event or by the activity. Either you should get a benefit, and the indemnifier says, we will give this benefit to you, but in case anything happens, you have to compensate. As in the case of the share physical transfer, the duplicate certificate case. Or insurance, where the indemnifier says, look here, you pay me the premium. In case anything happens, I will cover it. So that way, insurance is a contract of contingent contract. Okay, in that sense, most contracts of indemnity have an element of contingency built into it. When you're auditing a company, please ask if they have given any indemnity bonds for any purpose. If they have, then it has to be disclosed as contingent liability. At least the disclosure should be made that the company has issued a indemnity bond. Even a guarantee, because in both cases, in case that event occurs, the company will have to compensate, right? So the liability is not today. The liability may never occur. But because the company has given an indemnity bond, the bond is hanging like a Damocles sword. In case the event occurs. In fact, of course, many indemnities are permanent. Some are like insurance, they have a time limit. The insurer's liability under the indemnity bond called insurance policy, indemnity contract of indemnity, is only for 1 year. And that too, it is time bound. It begins with the second you cover is on. When you pay the premium, the cover begins. The time you pay the premium, the cover begins. Without paying premium, cover cannot be given. See, insurance is a cash and carry business. You have to pay the premium. That minute you pay the premium, the cover begins. Till exactly 1 year later, exact time, midnight, whatever, it will get closed. Thereafter, if anything happens, the insurance company, unless the policy is renewed, the insurance company is not liable. So indemnity, contracts of indemnity may be period bound, may also be permanent. For example, this physical share certificate, duplicate issue of share certificate, it will be going on and on because we don't know when it will happen. So whenever it happens, you have to come and indemnify. So a contract of indemnity may be express or implied. Express means when it is in writing or word of mouth. Word of mouth. Even if it's oral, it is express. Point here is how will we prove it now? That is not our problem. If it is oral also, it is allowed. Express contract is oral or written. Okay, where a person expressly promises to compensate the other from loss. A contract of indemnity is to be implied when it is to be inferred from the conduct of the parties or from the circumstances of the case. Right? See, I'm giving an example, tongue in cheek. Okay, tongue in cheek. A lot of public liability is there. For example, you are going to an amusement park, right? And of course, that would not come under strictly under contract of indemnity. That would rather come under the law of tort, where you go to an amusement park and then somebody goes to an amusement park. There is a problem with one of the equipment, and then there's a casualty or a injury. There's an implied contract to compensate him for his because you conducted the whole thing. You wanted us to come. You collected and all that. In fact, the indemnity cannot, the liability to compensate cannot be contracted away. In fact, I was advisor to amusement park. They wanted to say, anything happens to you, it is your liability. I said, no, sir, you can never put that. If you have decided to invite them and put them on high places and take them in 360-degree revolutions round and round, and you are using mechanical equipment for that, and it's your job to get it maintained. If anything goes wrong, you are liable to compensate under the law of torts. That sort of implied contract of indemnity, I would say. The minute this guy buys the ticket, there is a implied contract of indemnity. In fact, they wanted to print on the reverse side of the ticket that there is no liability. I advise them, don't do it, because even if you do it, the guy goes to court, he will get his money. Better not. Rather maintain your equipment well and get a good name rather than go for this type of things. This is exactly what they did. So they had no casualty or no injury at all. Right? Of course, that is another big ocean of law, where the law of torts combined with the implied contract of indemnity, where whose liability was it? How much of it was due to the faulty? Because some people, they will take a risk. For example, they would have very clearly said, when you're going on the roller coaster, do not stand up or do not, do anything except sit where you are. Suppose this guy goes and stands up or does some trick, he falls and dies. So a lot of things are there. As you can by now understood, as you would have by now understood, law is quite interesting, but you cannot oversimplify law. You cannot oversimplify law and say this is what it is, that is what it is. Every case, everything, you have to go from the circumstances of the case. Two situations may seem almost the same, but one small difference, the way you apply the law will be different. So as in the case of any contract, there should be an offer and acceptance. Yeah, could be, Ms. Patkar, and could be. In fact, one of my favorite enactments is the Contract Act. Okay, but then we are advanced level of Contract Act. So we assume that you know all this, offer and acceptance. See, in both my examples, was there an offer and acceptance? Yes. In the first example, the offer was made by the indemnified, who goes to the company and says, issue a fresh duplicate certificate. Offer. Okay. Then the indemnifier, the company says, we'll do it, but give us a indemnity. So offer and acceptance. When the indemnified issues the indemnity bond, offer, acceptance, close, contract. There should be an intention to create a legal obligation. See, that is why gambling contracts do not come into this category at all, neither indemnity nor guarantee. Because there is no legal obligation here. You cannot enforce a gambling debt. Okay, most states in India have banned any kind of gambling or wagering. Gambling is out. Okay, if somebody is doing it, it's illegal. So don't even ask me a question, sir. What about online rummy and all that? Okay, online rummy is 100% you cannot enforce the contract. Telling you, go there and say, no, I won the money. He didn't give me. Sorry. If somebody is playing online rummy, they are taking a high risk in every way. Okay, not a good idea. Because I don't think any CA student will ever even think of going for online rummy. But online rummy is contract of gambling contract, wagering. See, it looks like a game, but basically it's based on eventualities. You're betting on them. Consideration should be there. We already saw the consideration, how it is flowing. In the case of insurance also, there is an offer. The insured, the potential insured goes to the insurance company and requests them to issue a policy. Offer. The company issues the policy. Premium is paid. Policy is issued. Offer, acceptance, contract. Consideration, contract. So competency to be there. So both the indemnifier and the indemnified should have competency to enter into a contract. Free consent. It should not be. You cannot. There is. The indemnifier cannot threaten the indemnified or use coercion or any other method to obtain the indemnity. Free consent. Lawful object. The agreement must not be expressly declared to be void. I gave a simple example of gambling. Okay, straight away. Gambling is a contingent contract but banned. So the terms of the agreement must not be vague or uncertain. See, in the case of duplicate share certificate, the terms are clear. We are issuing the certificate. In case somebody comes and claims that there is a true owner, we are liable to the true owner. Whatever he claims, that you have to compensate us. The terms are clear. Insurance also, the risk is clearly covered. I'm sure you won't have the time or energy to go through an insurance policy, but sometimes today what the insurance companies do is they give a summary of the policy. Do go through it. You will see a lot of restrictions there. You'll be very surprised, especially motor insurance. They have put a lot of conditions. Many times, these conditions may not be satisfied. For example, You are a person who is, insurance policy. If there is an insurance policy, you're not supposed to do certain things. For example, on a motorbike, if there is an insurance policy, okay, going on high speed and then doing a wheelie, it's definitely not covered. They would have excluded it there very clearly. You're supposed to do only what the motorbike is supposed to do, okay, which is being driven on a highway or on a road. Try to do wheelies or jumps and all that, and something happens. They will say, look here, you want to do things like that, boss, no problem. I will cover that risk, but the premium will be higher. That's all. See, the beauty is, in fact, if you are a hardcore insurance man, you will say any risk can be covered, but the premium has to be determined. Any risk. So when the risk being covered is something that happens regularly, we have a lot of people exposed to it, the premium will be low. But if you're going to do something that's very special category of risk and very few people are there, the insurance will be higher. The premium would be higher. That's it. The agreement must be capable of performance. An agreement to do an impossible act is void. All this is part of your original contract act. And any legal formalities, in case, see, under the Insurance Act, there is a lot of formality. The way the contract should be drafted, stamping is there. You have to affix the stamps. All that is there. So any other formality should be complied with. Now, 125, only 2 sections. That's all. The entire topic, only 2 sections. What is the promisee? That is the indemnified, entitled to recover from the promisor. All damages which he may compelled to pay in any suit. Okay? In respect of which the promise to indemnify applies. So, I gave you 2 examples. I'm still working with it. Suppose the true owner files a suit against the company and the company has to hire a lawyer. Finally the case is lost and the court awards damages to the, whatever damages we are paying, the indemnity bond is invoked, the indemnifier has to pay. All costs which he may be compelled to pay in any suit. Okay, because ultimately we presume that there will be a suit. Okay. Now, so lawyer fees, legal fees, court fees, everything has to be paid by the indemnifier. All sums which may have paid under the terms of any compromise of any such suit, if the compromise was not contrary to the orders of the promisor and was one which would have been prudent for the promisee to make. This is a little tricky, but then there's no other go, because I have compromised. Because I have to get out of it. He is asking for so much. He is asking for 10 lakhs. So the lawyers talk to each other and finally they come to a conclusion. Okay, give us 8 lakhs, we will go away. I pay 8 lakhs. I have compromised. As an indemnified, I am entitled to receive it from the indemnifier. In the case the company has compromised with the true owner, then whatever the amount they have paid, the only thing is it should have been prudent for the promisee to make in the absence of any contract. Suppose there is no contract of indemnity, it is your loss. Then would you have compromised or would you have continued with the suit? If the answer is I would have compromised, then the indemnified also has to pay, receive it. Okay. So the indemnifier has to pay. These are the amounts that the indemnity holder. We use the word indemnified. We can also use the word indemnity holder. Both are equal. Both are synonymous. So that way the contract of indemnity is a fairly simple contract. In fact, most indemnity bonds, once issued, will be they'll be simply lying there, except the contract of insurance. Even a contract of insurance, 85, it depends. I don't know which insurance, but motor insurance possibly. Okay, 40 to 45% of the time, or even 50% of the time, the policy will never be invoked. It will simply sit in the car or in the locker, and at the end of the year, renewal will happen. They will get a no claim bonus because no claim was made on it. So like that. But sometimes it could be. That's about it. Okay. So it is not. Amanji, I think your mic is the problem. Please do not give comment like this, because if my mic is muted, the tech support gentleman will tell me that it is muted. Okay. Check your thing. Similarly, do not give request for repeating topics. Do not give request for repeating topics. It cannot be repeated. Whatever was told, it is available in a video. If you want to, if you missed it or you don't understand it, you can always go back and see it. 1. 2. If you have any specific doubt, Ms. Daneshwari, you are entitled to ask, and I will clarify. But again and again, if you want people to cover the same topic, it's not going to happen. Time is not there. Do you have 125 is a very simple section. What are the amounts that the indemnified can claim? Any damages which he is compelled to pay. Whatever loss he is incurring, he is entitled to claim. That's all. They are giving 3 types of names. Damages, costs, means any legal fees or any other cost that he may incur. That's why I gave an example for you to understand. So the company is issuing a duplicate certificate. Now that there might be a true owner without our knowledge, he may come and claim. So when he claims, I have to compensate. I have to pay him. Whatever I pay him, the indemnifier, this is the guy to whom I issued the duplicate certificate, should pay me. Suppose I compromise, suppose I agree to pay a lower amount and get out of it, that and withdraw my suit case, that also the indemnifier should pay everything that the indemnified is forced to pay, okay, or compelled to pay, okay, on this case. Okay. So Daneshwari, I have explained it again in spite of my refusal to do it. I have done it again. So in future, students like you who are highly intelligent should not ask repeat. You should ask for specific questions. Sir, what do you mean by cost? What do you mean by compromise? If you ask, I will definitely tell you. I will explain. Otherwise, it will be very difficult. Very difficult to do. Ayush Agarwal says, sorry, life insurance can't be a contract only, loss must be caused to indemnifier by a third party. That is what life insurance. That's why even I was a little tongue in cheek about life insurance, but absolutely correct. Death is not something which is caused by third party or by natural. Yeah, but in a way, death is natural events. See, technically, life insurance is also termed as a contract of indemnity. But if you still feel honestly that it is not, and it's a special category, it's okay. But anyway, the life insurance company promises to compensate the survivors, the legal heirs, in the event of death. So death is the event there. So maybe if you honestly think that way, I wouldn't argue with you on this. Okay. Yeah. All of you, please note, do not give comment about connectivity in this query pad. Why? Because it is of no use to you or me. It's only wasting our time. Reason, suppose it is not, you have a problem. I think there must be a helpline to the tech support. Please go put a message there. Or, okay, if you are going to put a message, I will ignore it. Now itself I'm telling you. Repeat messages will be ignored. And connectivity related messages will be ignored, because it could very well be connectivity at your end, or it could be doing something else. So, and whatever it is, I cannot control it. I'm using a particular connectivity which is given by a particular company. If that is not good, that is not good. That's all. I cannot do anything about it. Sitting here conducting this class, I cannot do anything about it. Yes, there must be a loss. Absolutely correct, Somesh. There is a must required to. I wish you could be more. Yeah. If your point is it necessary that there should be a loss? Yes, there should be a loss. If the indemnified has not suffered any loss, there is no way he can go and claim. Potential losses cannot be claimed. There should be an actual loss, which I have incurred, which you have to compensate. Of course. See, there is a contract of insurance called third-party insurance, where any damages which have any loss of life or limb or in an accident, Mr. A is the owner of a car. He is driving the car. There is an accident. Somebody is injured. that in addition to one damage, the car will be damaged. That is one contract. In addition to that, in a motor insurance contract, there's a third party also. There's a third party cover. The third party cover is to protect the owner of the car from any suit filed by a third party who is injured in the accident. So when the third party is filing a suit on the insured, all he has to do is to go and inform the insurance company and file a claim. Then the insurance company will conduct the case and they will pay everything. They will conduct the case on behalf of the insured. You'll give a wakalat to that and you'll give a power of attorney to them. They will take care. They will file the suit. They will. So whatever damages ultimately are claimed, they will pay. Any legal fees, they will pay. Any compromise, sometimes they might compromise. The injured person's lawyer will, once there is an insurance policy, the suit will directly be filed against what will happen is they will file it against the owner of the vehicle. The owner of the vehicle will make a claim, and with that, the case will be taken over by the insurance company, and finally the compensation will come. Okay, so this is called third party insurance, which is part of the motor insurance, whatever it is. Liability of an indemnifier commences as soon as the liability of the indemnity holder becomes absolute and certain. That is exactly what Somesh is telling. There must be a loss. The liability of the indemnity holder or indemnified becomes absolute and certain. Potential losses cannot be claimed. Only actual losses can be claimed, or which have to be incurred can be claimed. Okay. Pretty simple topic. Indemnity, very rare. You'll get 1 or 2 questions in indemnity. Whereas contract of guarantee is huge. From now on, it's going to be only contract of indemnity. Sorry, contract of guarantee. We have finished contract, that's all. Contract of indemnity over. Now from now on, it is only contract of guarantee. Now, guarantee is a little more complicated. One more thing, the contract of indemnity, guarantee, etc. have evolved because of the complexity of business. And again, they are not of recent origin. I'm going to show you a very old contract. They are as old as 1300 AD. 1300 AD you had guarantees. Indemnities and guarantees were there. 1300, etc. onwards. They became more and more evolved as the law became evolved in Britain and Europe. And most of this law was made in Europe and Britain. Okay, then it moved to the colonies, including the United States of America. Okay, so that's why you will find there are many British cases which are being, cited in this case. Okay, so what is a contract of guarantee? A contract of guarantee is a contract to perform the promise or discharge the liability of a third person in case of his default. Right? So, A promises to do something for B. A promises to do something for B. C promises to compensate B if A does not do it. A promises to do something for B or agrees not to do something for B, depends. Mr. C promises to compensate B in case A does not do it. In case of default of A, he promises. The person who gives the guarantee is called the guarant, is a surety, also known as guarantor. The person in respect of whose default the guarantee is given is called principal debtor. The person to whom the guarantee is given is called principal creditor. A guarantee may be either oral or written. See, whenever we talk about this, remember, oral contracts are perfectly legal. The problem is not legality. The problem is proof. So, Mr. A tells B something. What is the proof? Tomorrow he might come to court and say, I never said that. Unless, there is some eyewitness, somebody will come and... So, the whole concept of evidence and proof becomes difficult. Therefore, prudent people, intelligent people, smart people will put everything in writing. Reduce it to writing, sign, keep the papers, so that becomes safer. Better to have in writing. So that's why so instead of wasting your time on asking question on, sir, how oral contract will be proved? Why are you bothered? Why are you learning this topic? To give you understanding of law. One thing you should understand as a student of law and as a future member of the Institute of Chartered Accountants of India, never have oral contracts, never have anything in word of mouth. Somebody says something, ask him to put it in writing, sign and give. In case it's a contract, you also sign 2 copies, keep one to him. Tomorrow, if anything happens, you can always say, look here, this is what is the issue. For example, an engagement letter is a classic example. A client may call and ask you to conduct the audit, you agree. Everything goes on, oral. No documentation, no contract. Tomorrow he comes back and says, you should have done that. You promised to do this, you promised. When did you promise? How did you promise? What is the proof? Therefore, better you put everything in writing. Terms of reference. This is what you are going to do. This is what you are going to apply. And this is our deliverable. This is the fee. Do you agree to? The client signs, you sign, engagement letter, put it in the, then you can, okay, sir, I'm not going to be in practice, sir. I want to get into employment. Chalo. Most important contract in your life will be the appointment letter. That is a contract. Have it in writing so that tomorrow you will know what the employer is liable and what is not liable and what are your duties. Everything should be clearly mentioned. And there is a contract of employment in writing. Please, the lesson you get from this is not to waste your time worrying about how to prove oral contracts, etc., which is not for you unless you want to become a lawyer. Even a lawyer will avoid it. Even an advocate would say, sir, please don't do orally, put it in writing. Okay, oral understandings are difficult to do, but put it in writing. So don't bother wasting time. Many students ask me regularly, they ask, sir, how to prove oral contracts, sir, how to prove oral contracts. You can, very difficult to prove, that much I'll tell you. Okay. And it's anybody, whoever has a, better ability to lie will become the winner in that court. That's all. So better avoid oral, have writing. So, correct. Now let us understand from the example given by me, who is the surety, who is the principal debtor, who is the principal creditor. A promises to do something for B. Right? So A promises to do something for B. He's got an obligation to do something to B. So A is the principal debtor. B is the principal creditor. So A is the principal debtor. B is the principal creditor. C now promises to compensate B, the principal creditor, for any default on the part of A. So C is the surety. Okay. So in the problem given by you, A is the principal debtor, correct. B is the principal creditor, correct. C is the surety. That is all. Okay. We will see the difference between indemnity and guarantee in a short way. Don't worry. One immediate difference you can see. Can you see that? In a contract of indemnity, there are only two parties, the indemnifier and the indemnified. Here, there is a third party called the surety. That surety is in between. Suppose the principal debtor promises to compensate the principal creditor in case of loss. It is a pure indemnity contract. Here, what is happening? The principal debtor is not doing it. Some other third party called surety is coming in and saying, in case this fellow defaults, here only specific default. Whereas in the case of indemnity, the loss can be caused or the default can be by any third party or event of act of God or event also. But in guarantee, you are only concentrating on the specific default by the debtor. In case the debtor defaults, the surety will compensate, not the debtor. Whereas there, the indemnifier promises to compensate. Whereas here, a third party called surety promises to compensate. So that is possibly the essential difference. What is the difference in indemnity? Is surety also ready to compensate creditor? for default of principal debtor. Involvement of third party is what makes guarantee different. Absolutely, you are right. The third party coming in and giving a guarantee is how guarantee is created. Otherwise, there's no. Otherwise, the law of indemnity is enough for guarantee. Later on, you will also see that there is a built-in contract of indemnity. Maybe I'll explain it now itself. There again, you will understand. There is a built-in contract of indemnity between the surety and the principal debtor. Are you able to see that? See, surety is promising to compensate the principal creditor in the event of default. Once that is completed, once the surety pays off the principal creditor, there is an implied contract of indemnity by which the principal debtor has to compensate the surety for his loss. It is implied. Even if it is not in writing, it is implied. The minute the surety pays the principal creditor and settles the debt or makes good the obligation of the principal debtor, then the surety will become the principal creditor. And there is an implied contract of indemnity by which the principal debtor agrees to indemnify the surety on any loss that he may incur on account of the default of the principal debtor. So it's an interesting point. So every contract of guarantee has a built-in contract of indemnity between the surety and the surety. So the essential difference between indemnity and guarantee is there is a 3 parties in guarantee, 2 parties indemnity. Okay. Now, a well-known contract of guarantee. I don't know how many of you have read this play or even heard of the man who wrote it. Okay. It's a famous play. A Jewish money lender called Shylock is approached by a Venetian gentleman, a man from Venice called Bassanio. So 3,000 ducats. Ducats was the currency which was used in Venice at that time. Okay, so 3,000 ducats. Well, Bassanio says, I serve for 3 months. For 3 months. Well, see that Shylock is a Jew, okay, a money lender. Bassanio is a Venetian gentleman, a Christian. And he wants to borrow 3,000 ducats because he wants to, marry a lady called Portia, and that story is there. So he wants 3,000 ducats. I think that's simple. And he doesn't have the money. So he goes to his friend, a famous man called Antonio. And he tells Antonio, please give me 3,000 ducats. Antonio says, hey, Bassanio, you're my friend. I would love to give you whatever you want, but I don't have it with me because my ships are out to sea and all my money is locked in those ships or in a particular ship. So why don't you borrow the money? I will guarantee it. In case, don't worry, you don't have to pay, I will pay. So this man goes to Shylock, and that's how the story gets. Shylock hates Antonio. And Bassanio goes to Shylock and says, I want 3,000 ducats. I serve for 3 months. For 3 months, well, Bassanio, for which, as I told you, Antonio shall be bound. Antonio shall be bound. Antonio shall be bound. Well, may you state me? Will you pleasure me? Shall I know your answer? See, Bassanio is eager to borrow the money and run because he wants to go to another city. I don't know where. Padua, I think, where he has to court a lady called Portia and marry her. That's how the story goes. Shylock says 3,000 ducats for 3 months and Antonio bound. I think I may take his bond. Now, while you might not enjoy reading Shakespeare the way I do, you will definitely see this is a classic example of a contract of guarantee. Now, there are 3 people here. 2 are talking to each other. 1 is mentioned. Now, I want you to tell me, in this example, who is the surety? Yeah, it is The Merchant of Venice, a very famous play by a man called William Shakespeare. Okay, if you have never heard of this gentleman, first time I'm introducing you, I'm happy, but I'm sure many of you would have had a text in 10th, as somebody is saying, or in 12th. So, of course, I didn't do this in 10th. I did Julius Caesar, but I've read almost all the plays. But for a few, I've read almost all the plays of William Shakespeare. Wonderful plays. But then, in this example, sir, most of you pure accountants there, students of institute are angry with me. Useless act. Why are you giving me useless information? Merchant of Venice, I don't need to know all this. I have to pass my CA exam. Like that. I can understand people getting angry. But in the meantime, tell me who is the principal debtor, who is the principal debtor, who is the surety. So let's see. Ilavarasi says Shylock is the debtor. Huh? How? Shylock is lending the money. He's lending the money. How he can be the debtor? Madam, when you are lending money, you are not the debtor. When you borrow money, you become debtor. Who is borrowing here? Who is borrowing here and who is lending? Okay. Ms. Ilavarasi, kindly review. Who is borrowing, who is lending? See. So, though the example is given from Shakespeare, the commercial part of it as a chartered accountant, you should be clear. Think like a chartered accountant. While even reading Shakespeare, think like a chartered accountant or think like an accountant. Shylock is the creditor. Absolutely correct. Bassanio is the borrower. He is the principal debtor. Shylock is the principal creditor. And Antonio is the surety. Okay. So absolutely correct. Akash Nil gives it correctly. Surety Antonio, principal debtor Bassanio, principal creditor Shylock. Try to avoid using the words surf, debtor or creditor. Don't use that. Use the whole term. Principal debtor, principal creditor. Because the words debtor and creditor have different meaning. In the contract of guarantee context, please use the word principal debtor, principal creditor. Okay. Shylock is creditor. Correct. Antonio, all of you got it right. The whole story revolves around the fact that Antonio was the surety, the guarantor. And finally, unfortunately, Antonio's ships are lost in sea. But so he doesn't have the money to pay Shylock. And Shylock enforces the contract of guarantee. And you know how that story goes. And finally, how Antonio is saved by Portia and all that. It's a nice story. Do read it if you have time, maybe after you become a chartered accountant. Okay, so this is how the contract of indemnity works. There is a principal debtor and the principal creditor. There is a principal contract between them. See, basically, when the principal creditor lends money to the principal debtor or appoints the principal debtor, whatever he does, yeah, absolutely, Bharat, pound of flesh and all that. There's absolutely no time for me to go there. If I have tickled your interest, okay, even if you cannot read the entire play, just go to Wiki and read the story and all. Maybe not everybody will like literature the way I do. So, not necessary that you should read. Okay. So, there is an essential basic contract between principal creditor and principal debtor, by which, see, that contract is valid. It's not as if because there is a guarantee, the principal debtor can simply walk away. Principal debtor is primarily liable to the principal creditor, primarily liable. Okay. Then there is a secondary contract between the creditor and the surety, where the surety promises to compensate the creditor in case of default of debtor. Please note, the second contract is between surety and principal creditor. The principal debtor is basically a third party here. Honestly, the principal creditor need not even see. The principal creditor should ask the principal debtor to pay. Compulsory, very important, and should give a reasonable time to the principal debtor to pay. The minute there is a default, straight away the principal creditor can invoke contract number 2, which is the contract of guarantee. Contract number 2 is essentially the contract of guarantee, right? This is the contract of guarantee. This is a basic contract between the two guys. So, if the principal debtor repays the money to the principal creditor, absolutely no problem. Matter over. If Bassanio had simply paid the money to Shylock, matter over. Which is what he promises to do later. He says, look here, I've got the money. My wife Portia has money. I'll give you. But by then Shylock is, mad. He's saying, I don't want your money. There is a default and I want the pound of flesh from Mr. Antonio, who is the guarantor. See, that was the dangerous guarantee that Antonio gave. If he had simply said, I'll pay the money, no problem. He said, in case Bassanio does not pay, you can take a pound of flesh from my body. It's a beautiful thing. That's why the word pound of flesh is called. Beautiful, Prabhas. I'm happy that you read the entire play. Good. Sorry to make this into a literature class rather than a... All I'm trying to show here, my dear friends, is knowledge is overlapping. If you try to compartmentalize your knowledge and study like that, your knowledge is imperfect to that extent. But when you are willing to open your mind and let everything in and compare and study, your knowledge will go up. The way you look at the world will change. And the way you look at the world changes, your life will change. But unfortunately, when you look at through a narrow like this, what you see? You see only what you see. You don't see the whole world out there, which is all I'm trying to show you. Okay? So, it is your choice. Please, I'm not recommending the way I live is the right way, but it's a great way. When you are able to open up, learn, everything teaches you. Of course, you still prefer to read only the book given by the, whatever, the coaching class and go like an IAS exam, you write the exam, pass. You will be like a government officer thinking only one track. Okay? Expand. It's up to you. Choice is always yours. Okay. Now, very importantly, do you see the third one? There is an implied contract between the surety and the principal debtor. See, this contract, my dear friends, is implied in as much as, see, this could be in writing. This could be in writing. This could be express, either writing or word of mouth, but something is there. But third, nothing. All that the surety has to do is settle the principal creditor. The minute the principal creditor has settled, then there is an obligation. The principal debtor is under an obligation to indemnify the surety if the surety is made or to pay or perform. So the minute the surety has performed on this contract, I'll give an example, simple example. Principal creditor is lending 1 lakh to principal debtor. Surety says, in case this fellow does not pay within 3 months, I will give you, I will pay. 3 months over, principal debtor does not pay. Principal creditor sends one notice, please pay, he ignores it. Then he goes to the surety, surety pays him 1 lakh. Now, once the surety pays the principal creditor 1 lakh, this contract is completed, this is defaulted. Now the principal debtor still owes 1 lakh. He owes 1 lakh, but not to the principal creditor. Why? Because surety has already paid him. The surety has already paid him. So principal creditor is now out of the picture. Now the principal debtor owes the money to the surety under the implied contract. Not only the 1 lakh. Suppose the surety had paid some interest, some other things, anything, whatever loss incurred by the surety, the principal debtor is implied contract of indemnity to compensate. There is an implied contract of indemnity to compensate. Right? Hope you have understood this. It's not very difficult to understand, but interesting. It's good to know. For a valid guarantee, these things are required. A principal debt, there should be a debt. Okay? And it should be a recoverable debt. It should be something that the principal creditor can recover. See, I will give a simple example to help you understand. All of you are aware of period of limitation, right? Period of limitation. That is, once you lend money, your suit should be filed within 1 year. I'm sorry, within 3 years. Within 3 years. That is the period of limitation. You have lent money to somebody or you have supplied goods to somebody, amount is due, that amount should be recovered or you should file a suit within 3 years. If third year is over 1 day, the debt becomes time barred. Now your time barred debt cannot be claimed or recovered. Now, so it cannot be recovered because you cannot file a suit. Very important. So you cannot give a guarantee for a time barred debt. There should be a recoverable debt. B requests A to sell and deliver to him goods on credit. No problem. B is telling A to sell goods to him on credit. A agrees to do so, provided C will guarantee the payment of the price of the goods. So A says, look here, you want credit, I'll give you, but ask C to guarantee. In case you don't pay, C will pay. C promises to guarantee the payment in consideration of A's promise to deliver the goods. So this is sufficient consideration. It's a classic example of guarantee. It need not always be money being lent. Even goods can be sold on credit. So long as the principal debtor has an obligation to the principal creditor and the surety agrees to compensate the principal creditor in case the principal debtor does not pay, contract of guarantee. So there should be a consideration, which is anything done or any promise made for the benefit of principal debtor. See, in this case, A has not yet sold the goods. A promises to deliver the goods. There is a promise made. Suppose actually he lends money. Actually money is given to the principal debtor. That is anything done. Or, okay, don't worry, I promise. Whenever you want goods, I will supply, provided C guarantees. So, A's promise to supply is the consideration for the contract of guarantee of C. C is giving it. Both the act as well as the promise should be for the benefit of the principal debtor. The principal debtor should get some benefit out of this. That is the consideration for the guarantee. Right. There should be a liability. There should be an existing liability or a promise whose performance is guaranteed. Such liability or promise must be enforceable by law. The liability must be legally enforceable and not time barred. That is what I explained to you. Time barred. There is something called a period of limitation. Beyond the period of limitation, see, a time barred debt may be paid. Okay, nobody, suppose the principal debtor is honorable and he wants to come and pay later, he can. But the creditor cannot file a suit to recover after the period of limitation. You have no legal remedy anymore. Okay, got it? That is why, I don't know if how many of you will remember this. When you studied contracts without consideration, section 25 of the Contract Act, how many of you even remember it? I don't know. One of that is a promise to pay a time barred debt. See, the time barred debt cannot be enforced. Time barred debt cannot be enforced. But somebody says, I owe you that money, time barred, still I promise to pay. Then even though there is no consideration, it's a valid contract. That is section 25 of the, but that promise can be made. But a time barred debt cannot be guaranteed. I repeat, a time barred debt you can promise to pay. See, the principal debtor after the period of limitation can say, boss, I owe you that money. I know it's time barred, but I am honorable. I can't pay today. Give me 1 year time, I will pay you. That's a fresh contract, though there is no fresh consideration. I promise to pay a time barred debt. That is why it's one of the exceptions. Contracts where consideration is not required. Contract with the, you might have studied it. I'm sure if you have forgotten it, you are entitled to forget because, but then if you remember it, it will be good. But be careful. Yet I'm repeating it. The liability for when you are giving a guarantee, the liability must be legally enforceable and not time barred. A time barred debt cannot be guaranteed. Write it down somewhere if you want. A time barred debt cannot be guaranteed. A sells and delivers goods to B. A sells and delivers goods to B. C afterwards requires A to forbear to sue B for the debt for a year and promises that if he does so, C will pay for them in default of payment by A. See what happened? A supplied goods to B. B owes money. B has not paid. Now A wants to file a suit against B. Now C tells A, please forbear, please avoid. Forbear means avoid suing for 1 year. Give him 1 year time on my behalf. In case he does not pay within 1 year, I will pay in default. So A agrees to forbear. There is a sufficient consideration because at this point in time, it's a valid debt. Yeah, it is enforceable by law. It's not time barred. You can do it. Now, A sells. See, one more thing is this should be done at the request of the B. Okay. Otherwise, why is A coming in? A sells and delivers goods to B. C afterwards, without consideration, without any agreement, without any. See, B has not even asked him to pay. He agrees to pay for them in default of B. So there should be a request by B to give a guarantee. Without that, it's not valid. Why are you coming and giving? But of course, still there could be a liability under quasi-contract and all, but not here. not here. There should be a valid debt, and at the request of the principal debtor, the surety should promise the principal creditor to compensate in case the principal debtor defaults or does not. Somebody wanted difference now here. There are so many differences. Let me not, because 100% this is not going to come as a question in the exam. So, how will the principal debtor become the surety? No. Principal debtor does not become surety. Once the surety settles the principal creditor, the principal debtor becomes an indemnifier and the surety is indemnified. There is an implied contract of indemnity. So, within this framework. In this contract, principal debtor cannot become surety. If you think he can, tell me how, so that I will try to address your question. Because sometimes, many of you make statements without a question mark. So, if Ankur Patel is saying principal debtor may also become surety, I may answer it. I'm not agreeing with it. But if he's asking, then my answer is no. In this context, he will not. See, the same principal debtor in some other contract, he can make it become surety. But in this contract, principal debtor will always be principal debtor. What could happen is, when the surety settles the principal creditor, principal debtor will then take over the liability, or he will have the same obligation of an indemnifier. That is agreeable. But he won't become guarantee, he won't become surety. Please, the word surety and indemnifier are not synonymous. The word surety and indemnifier are not synonymous. The indemnifier's obligation is different, surety's obligation is different. Okay? So, though it seems to be similar, they are different. The indemnifier, there is a contract between the indemnifier and the indemnified. Please note, here in a contract of guarantee, there is no contract between the principal debtor and surety except an implied contract, which comes into existence only on settlement. The contract is between the surety and the principal creditor. Got it? So, in a contract of guarantee, there are three parties, whereas here there are only two parties. The liability of the indemnifier is primary and unconditional. In case anything goes wrong, the indemnifier is directly first liability, whereas the liability of the surety is secondary and conditional. Liability of the surety is secondary and conditional. Friends, you are going to study Negotiable Instruments Act later, I hope. Maybe after this session you will study. There again you will find there is an implied contract of indemnity and also guarantee. There. Implied contract of guarantee is there. You will understand it only when you go there. See, when I am the drawer of a bill, okay, and the bill is accepted, okay, the payee has possession, the payee goes to so the primary liability is the drawee. Primary liability is drawee. But in case the drawee does not pay, the drawer is liable. So it's implied contract of guarantee there. When the drawer of a bill of exchange becomes the guarantor. In case of default by the drawee, either non-acceptance or non-payment, the drawer will become liable as a surety. Okay. Because the principal debtor is the drawee. The payee is the principal creditor. Okay. If you don't understand this, no problem. Make a note of it somewhere. When you are taught negotiable instrument, you will immediately get it. The relationship is the same. Okay. The drawer is directing the drawee to pay money to the payee. Drawee accepts it. Then he becomes part. Then he defaults. Then automatically to whom will the payee go? To the drawer. If any endorsement happens, the endorsers also. So on and so forth. Okay. Interesting topic, Negotiable Instruments Act. At the core of it is the contract of surety guarantee. The liability of the indemnifier arises only on the happening of a contingency. So here, the happening of a contingency, an event, which could be behavior of the promisor or by third party or by an event. Whereas here, guarantee the liability arises only on the non-performance of an existing and specific promise or a non-payment of an existing debt, specific debt. So behavior of the principal debtor alone is important. Here, It could be due to the conduct of the promisor or any other person or even an event. The indemnifier need not act at the request of the indemnity holder. Okay, the indemnifier can give a indemnity, which is why they say for contract of indemnity there is no need for consideration. That is not correct. Okay, but there will be a consideration. The indemnifier gives. Whereas the surety acts at the request of the principal debtor. Please remember this. Surety simply here example of without any request from the principal debtor, surety gives the guarantee, not valid. Okay, but I'm a little skeptical about this. Is a difference because even in the case of indemnity, the indemnifier acts at the request of the indemnified usually, but then it is not needed. Is the usually the indemnifier will not on his own volition come and give a contract indemnity. There will be a request from the indemnity holder to give. And the consideration is that the indemnity holder will do something for the benefit of the indemnifier. See, the indemnifier cannot sue a third party for loss in his own name, as there is no privity of contract. There should be an assignment. As I told you now, the court case, if it's filed against the indemnified, the indemnifier should get an assignment or should get a power of attorney in his favor. Only then he can proceed. Surety can proceed against principal debtor in his own right because he gets all the rights of a creditor. Once the debt is paid, once the amount is paid by the surety to the principal creditor, he gets all the rights of the principal creditor and he can sue the principal debtor. Okay. The purpose of indemnity is reimbursement of loss. The purpose of guarantee is, I'm so sorry. The purpose of indemnity is to provide a security to the creditor. It's actually a security. Later on, when you come to final exam, syllabus 186, you will talk about making of intercorporate loans. You will also talk about giving guarantee. So that is why we are teaching you here, so that you will understand it there. So when the company, instead of giving a loan, they give a guarantee. So to another company, they are not giving a loan. Instead, that company is borrowing and this company is giving a guarantee. So guarantee is there. All parties must be competent to contract indemnity. In the case of guarantee, the principal debtor may be a minor. In the case of guarantee, in the case of indemnity, both indemnified and indemnified should have competency to contract. But in the case of guarantee, minor, see for example, minor can be a principal debtor. For simple example, parents are putting a child in this boarding school. Maybe that boarding school has a thing that says, in case your child or your ward breaks or destroys anything, you have to compensate for it. So, as part of the application form, there is a contract of guarantee by which the parents sign or the guardian signs and says, in case this minor breaks something out, I will compensate. Because the minor is not bound by it. So, allowed. Where the principal debtor is the minor student. The principal creditor is the parent or guardian. And the surety is the parent or guardian. And the principal creditor is the school. It can be invoked. So I'm giving you some examples to help you understand, right? Part guarantee only for, let's see, I'll just finish this. Part guarantee, you can guarantee a part of the debt. There's nothing wrong. Suppose the debtor owes 1 crore, I can give a guarantee for 50 lakhs. Absolutely. That is allowed. So, it's not called a part guarantee. It's a guarantee for part of the amount due. I have got the difference between, there is nothing called a part guarantee. Okay, you cannot give part guarantee, but you can guarantee part of the debt. As I told you, the amount, the creditor has given 1 crore. I am the bank. I agreed to guarantee, but only 50 lakhs, up to 50 lakhs. So, allowed. So, the bank is the surety for only 50 lakhs. Beyond 50 lakhs, creditor has to suffer the loss. up to 50 lakhs I'll pay. Up to that 50 lakhs I can recover from the party. Acknowledgement of debt, exception to time barred debt. My dear friend Somesh ji, this cryptic telegraph language, I'm not able to understand. What do you mean by acknowledgement of debt? No. So, okay, you are saying, okay. I'm able to decipher what you're saying. Suppose there is a time barred debt, and debt is being promised. That is, the debtor is promising to pay a time barred debt. Will that amount to exception, sir? No. Time barred debt is gone, sir. It cannot be, because maybe suppose a new contract is entered into for the payment of that amount, that contract can be guaranteed. Though the debt was time barred, now this guy is creating a fresh. He's creating a new contract. This can be guaranteed. That's what you're asking? Okay. In continuous discounting of bill with bank, implied contract. Yeah, when a bill is discounted, what happens? The party, the discounting party becomes a kind of a surety. In case the customer does not pay, then you have to pay. Exactly. That is why I said endorsement. The endorsers are also guarantors. Here is an endorser. See, Ms. Daneshwari, don't say implied contract. What contract? There's an implied contract of guarantee. In case of discounting with bank, who is the guarantor here? There's see, I have sold goods to a big company. That company, I have also raised a hundi on them, a bill of exchange. They have agreed and they have given it to me, which means they agree. I have drawn the bill, they have accepted, and then I give it to the bank. And the bank gives me money immediately. On the due date of the bill, when the bill is to be presented, the bank will present the money and collect it. In case the company does not pay, I have to pay. So in a way, it is the contract of guarantee, where that company is the principal debtor, the bank is the principal creditor, and I am the surety. In case the principal debtor does not pay, I have to pay to the bank to the extent of amount discount. Don't worry, in banking it's well known, and discounting a bill, automatically they'll put the guarantee clause there. As part of the discounting agreement, there will be a guarantee clause. The borrower hereby agrees to compensate the bank in the event of default by the said customer. Automatically there will be a contract of guarantee. Those people who are parties to a contract are having privity of contract. Okay, privity of contract in simple terms is right to sue under a contract. Right to sue under a contract. Who has the right to sue? They have privity of contract. Who has the right to sue? Offerer and acceptor. Okay, the two parties only have right to sue. Third party cannot sue. He has no privity of contract. Another way we say it is, the third party has no locus standi. It's a Latin term meaning right to sue. What is your locus standi? Where do you get the right to sue here? This contract is between me and him. Who are you to sue? Okay. So, yeah. Letter of credit is one type of guarantee. Absolutely. Letter of credit is one type of guarantee. Again, absolutely. A letter of credit is one type of guarantee. See what happens? There is a foreign buyer. Letter of credits work like this. I'm talking about foreign letters of credit. There is a foreign buyer. I'm an exporter. I'm exporting goods to him. My banker, okay, is willing to negotiate, but he says, please get me a letter of credit from a foreign banker. So a foreign banker acts as a surety for the foreign customer. The foreign banker acts as a surety for the foreign customer, right? So that letter of credit is issued by the foreign bank to me, and I then give it to my banker. So that letter of credit is a kind of a surety. But the beauty is, I do not come into the picture at all. Once I get the LC and I give it to my bank, now the three parties are very clear, right? My bank, who took the LC and discounted the bill, is the principal creditor. That the foreign buyer, the foreigner who buys from me, is the principal debtor. the foreign bank who gave the LC becomes the surety. Thereafter, I am out. Once the LC is valid, then the LC will be invoked on the foreign bank. Okay, but that's again an ocean of a topic. Ocean. Suppose you work in a company which is regularly exporting goods and importing goods, you will become an expert in LC, because one important condition is the LC should be valid. Once the foreign buyers bank, they issue the LC and I give the LC to and the goods are supplied. Okay. Then 90 days means 90 days LC means 90th day the foreign bank will pay to my bank. In case they do not pay, okay, their liability is there to pay. If the principal debtor does not pay, the bank agrees. But usually LCs will be immediately closed. All banks will close the LCs. But the format of this contract is surety. So the foreign bank is a surety for the principal debtor. So of course, very complicated. Huh? Suppose the foreign bank does not pay, then what happens? The LC is, that rarely happens, because once an LC is valid, it will be paid. That is where the problem is. LC will, what they will do, they will 101 things to escape liability, which is why exporting goods is, you have to be very, very careful. The goods, nature of the goods should be clearly mentioned. What is mentioned in the LC should be mentioned in the packing slip, in the invoice. Everything should match. Goods should go. Everything, whatever is the contract between these two people should be maintained. Only then the LC will be honored. Yeah, but basically LC is a surety. The foreign bank becomes the surety. The foreign exporter is the principal debtor. The local bank, my bank, is the principal creditor. Okay. Good. I hope I'm not complicating things for you, but I'm giving you commercial examples from real business situations where these things work. The principal debtor is already in default. Then now we can, sir, don't ask me all these questions. That is practical question you are asking me, Raghavan. Your question is very valid. Fellow could not pay the principal creditor. How he will pay the surety? Good question. I'll tell you how. I'll give you one example, but then please understand that you are asking a very, very practical question. In the exam, such questions will not be relevant. Principle of law is more important. What is the principle of law? Principle of law, understand. In case the surety settles the principal creditor, he has the right to sue the principal debtor. That is the principle of law. Now, how the principal debtor will pay and all, how can I am not his elder brother to help answer this question. But I'll give you an example. Some fellows are rascals. You know what they will do? They will not pay, but they will have huge assets. Fellow will be sitting on multi-crore worth of property. He'll borrow money and not pay, simply keep quiet, thinking that he can go to court and play games. Which means what? He is not paying. Default is not due to inability. Default is due to his not willing to pay, unwillingness. In those cases, he's got assets. Yeah, I'll file a suit. Let it take 5 years, 6 years. I will attach his property and collect my money. So, now, of course, why the principal creditor has not done this? Because he's got a surety. So, he invoked the guarantee. Now, the guarantor comes into the picture. Now, the guarantor has to take over and he has to file the suit and collect it from the principal debtor. Raghavan, if you have understood my answer, please tell, yes, I have understood, sir. I mean, why I'm making this request to all of you, know, in this mode, I cannot see whether you understood or not. So you asked me a question, I have given an answer. Many people are there like the rascals who will borrow money and they will have assets. They will be driving Benz car and a Audi car, but they will not pay their debts. They will owe money. They are all rascals. I'm sorry to use the word. In those cases, we have to file a suit against them and recover. It will take some time, but we can recover. This is a question I'm going to answer. Whether a guarantee can be revoked. We'll come to it. I'll answer that question a little later. Thank you. But again, remember the principle of law, if you should understand, then only. Practical depends. Definitely see, in many cases, I have advised my clients to let it go because fellow is not able to pay. What is the point in wasting our time? It's also valid. That is a call which you will have to take as a member of the institute in the finance department of a company. It's a very delicate call you have to take. Every day, you have to decide whether to sue, whether to recover, whether to use stuff, etc. Okay. Liability of surety is coextensive with that of principal debtor, unless it is otherwise provided by the contract. Please remember this word, unless it is otherwise provided by the contract. So if nothing is mentioned in the contract, whatever money is owed by the principal debtor is owed by the surety. So to go back to Pooja's question, part contract, what happens? In the contract, we can say principal debtor owes 1 crore to the principal creditor, but the surety is liable only for 50 lakhs. Then it is clearly provided in the contract that he is liable only for 50 lakhs. So, but if nothing is mentioned, whatever money owed by the principal debtor has to be paid by the surety. Whatever obligation the principal debtor had, the surety has to do it. Which is what we mean by the saying coextensive. So it extends along with it. Whatever is the liability of the principal debtor, along with that, the surety's liability also extends. The surety is liable for what the principal debtor is. However, the liability of the surety may be made less than that of the principal debtor by an express contract. As Pooja was asking us, can we have part? Yes, you can have part. But don't say part guarantee. We are giving guarantee on part of the amount. The liability of the surety arises only on default by the principal debtor. Where once the debtor is liable, he has to. Where the debtor cannot be made liable, held liable on account of any defect in the document, the liability of the surety also sees as. See, this is where LC, contracts of LC, the foreign banks escape. So they will point out small errors in the invoice and packing slip and all, and they'll say, this is not tallying, that is not tallying, and which is why when you're dealing in LCs, your bank, the local bank, okay, will be very, very particular about documentation. Because they know that if this document goes into international LC world, if it is even small errors there, they'll not get the money. Therefore, they will ask you to be very, very careful. Thank you. All of you have clearly. Surety's liability continues even if the principal debtor has not been sued or is omitted from being sued. So, see, the point is, the principal creditor has not filed a suit against the principal debtor. Omitted. Even then, the liability is there. Principal creditor need not sue the surety. Okay. He can simply invoke the guarantee and go. Automatically, the surety will be liable. But this part, we will revisit it again. There is one issue. But the surety may not sue, but he should not prejudice the interest of the principal creditor may not file a suit, but he should not prejudice the interest of the principal creditor. I'm sorry. He should not prejudice the interest of the surety. See, he has to file a suit within 3 years. Suppose he does not sue. He gives time to the principal debtor and the period of limitation is over. Then surety is not liable. That will be one of the discharge of surety examples. Because you are doing something that prejudices the surety's right. Okay, that's an exception. But normally, within the period of limitation, suppose the debt is due on 15th of August or 16th of August. 16th of August, debt is not paid. Liability of the principal debtor arises. There immediately the guarantee can be invoked and surety is liable to pay. Thereafter, he will file a suit within 3 years, he can file. Right? So, in those cases, not filing a suit against the debtor is not a problem. But be careful. The period of limitation, you should be careful. If you allow that to escape or if you forbear to sue and you allow the period of limitation to lapse, then the principal creditor is at fault. And the surety can say, look here, you did something that prejudices me. Therefore, I'm not liable. Now, there are 2 types of guarantees. Specific guarantee, continuing guarantee. Specific guarantee, continuing guarantee. A guarantee which extends to a single debt or a specific transaction is called a specific guarantee. The surety's liability comes to an end when the guaranteed debt is discharged or the promise is duly performed. Now let me answer the question raised by Madam. I explained coextensive so extensively. Were you listening or not? I explained coextensive in an extensive manner. Co-extensive means the surety is liable for whatever the principal debtor is liable. Co-extensive. Wherever the liability goes, the principal debtor goes, surety also goes, liability goes. Okay. If you have understood, please tell that you have understood, Aradhana ji. Co-extensive means whatever the principal debtor is liable, for that the surety is liable. I also gave an example of how that liability can be restricted by an express contractor. Okay. Please listen to the lecture and don't go away and then come back and say, ask what is this, what is that. And don't ask me to repeat it also. Okay. Of course, I hope co-extensive no clear, because my goal, the idea is not to avoid answering you, but you should also see the time of everybody. You should be alert and active. So slow students, if you are understanding is slow, one suggestion I'll give you: make notes as I'm talking. I find that most students, when they write, their ability to understand is better. For example, when I'm giving an oral example of A, B, C, have a paper and pen with you and draw the diagram. Make notes. Don't take dictation of whatever I'm telling. No. Whatever I'm telling, convert it into diagrams, convert it into thoughts, write it. See the power of remembering. Okay. Good. That's the only way to remember. Many students ask me, sir, how do I remember? How do I remember? You remember by concentrating. You remember by applying your entire concentration onto that topic. You remember by trying to think. I don't know if it is okay. What I wanted from you, Aradhana, was whether you have understood or not. I know it's okay, but I want to know whether it is. Thankfully, you have not put okay, K. Okay. Maybe I'm becoming older and unable to understand the new generation and the languages of the new generation. Anyway, but now I'm slowly getting used to OKK. When people put OKK, okay. But don't be just to okay, yeah. Be better than okay. Understand it fully. I know, I'm sorry. I'm sometimes being a little too insisting on what you should do, how you should do, and all. It's up to you. Okay. 57 years, 35 years experience is thinking maybe we could share. But I also realize one thing: people will make their own mistakes. You cannot prevent people from making mistakes. I'm 57. I have the maturity to accept that the next generation will make its mistakes. Okay. We can only say, hey, don't do this. It's not a good idea because we did it and it didn't work. But then, anyway, maybe that is needed, because unless these mistakes are made, unless this testing is done, because when my father said I could not do certain things, I challenged him and I went on to do it. So sometimes I think the younger generation also should challenge the elder generation and say, but when common sense is being shared, you have to be very careful. When common sense is being given, be very careful. When an older Buddha is giving a common sense, ignoring the Buddha is sometimes very dangerous. Good. So, good show. Okay, now come to my good friend Pooja's question. What was her question? She was asking, Pooja PS was asking, can we revoke our guarantee? Okay, here comes the first answer. Specific guarantee cannot be revoked by the surety. Please understand, specific guarantee cannot be revoked. I cannot repeat it. I will repeat it again and again so that it will go into your brain. Specific guarantee cannot be revoked by the surety. Of course, the principal creditor can discharge. Please understand, who can discharge? The principal creditor can discharge. Who can discharge? How? The principal creditor can say, hey, I am releasing you from this year. But the surety cannot revoke. Once a specific guarantee is given, the liability of the surety is there. It will come to an end only when the guaranteed debt is duly discharged or the promise is duly performed. Okay. Now, so very important, specific guarantee cannot be revoked by the surety. Again and again, I repeat, buy the surety, because having given the guarantee, you are locked. Which is why, again, from a Buddha, one important common sense advice is coming, suggestion, and I have followed it in my life till date. That is why I'm leading a very happy and wealthy life. I'm able to retain my wealth and be happy only because I have not signed a guarantee document till date. I have never been a surety for anybody. Never. As a practicing member of the Institute of Chartered Accountants of India, I made it a point that I will never sign a guarantee. Whoever it is, whatever it is. Okay. Only once I signed a guarantee. My nephew was in US. He was borrowing from a life insurance corporation. LIC wanted a guarantee. Uncle had nobody to give the guarantee. He came to me and he said, Srikanth, if you trust me, you do it. On that one thing I gave, that got paid and revoked and all that. But the exception to the core, my maternal uncle, my mother's own elder brother, that's it. Chalo. But that my mother also said, hey, don't be such an ass. Do it for him on my sake. So I did it. That was an exception of the exception which I keep repeating. But for that, I have never given guarantee. Never. Okay, because the minute you give a guarantee, you are caught. And you will be in trouble. Don't give guarantee for people. No way. I mean, this is my view. As a member of our institute, don't do it. Because it leads to all sorts of compromises, all sorts of problems. Don't stand guarantee. Don't sign as a guarantor. Okay? Please, this is my suggestion to you. Don't put yourself in a situation in your life where you have to be a guarantor. Okay? Please. Don't take guarantee also. Be so good that nobody should give a guarantee for you. Okay? Why should somebody give a guarantee for you? You are your own guarantee. Your word should be your guarantee. If you say, I will do it, the world should believe, hey, his word is enough, man. No, nothing else is needed. That is the level at which you should live. But in commercial transactions, this is not possible. So, then who will give guarantee, you will ask me. I will tell you. Banks are professionally ready to give guarantee. And they give it in a bigger context. I'll give a simple example. Larsen & Toubro is engaged in construction contracts. Huge construction contracts. The government of Tamil Nadu or the government of Gujarat is giving a contract to Larsen & Toubro for construction of road, laying of road, 1,000 kilometers road laying contract. Huge contract. Bid is there, tender, bid is cleared. Finally, L&T is cleared as the contractor. Now, the government of Gujarat says, tells L&T, get me a performance guarantee. See, they may waive also in some cases, or at least they will say, for the total contract value is 2,000 crore. I want a guarantee for 300 crore. 2,000 crore contract, I want a guarantee. Because tomorrow, if L&T does not perform the job or there is a reduction in quality, the guarantee will be invoked. So, now who will give that guarantee? Larsen & Toubro will approach State Bank of India, or they might already have a line of credit with them, by which guarantee is also there, bank guarantee, BG limit. It is called bank guarantee limit, BG limit. So L&T will be having so many contracts here that BG limit itself will be huge. It will be 3,000 crore limit will be there. I don't know, just guessing, but it could be huge. So within that limit, they will go to, then they prepare the document in favor of the government of Gujarat. They'll go to State Bank of India, Bombay headquarters, Bombay office. They'll go through it thoroughly, and then State Bank of India will guarantee. They'll issue a BG. It's called bank guarantee. So this is valid, for which State Bank of India will be paid what is known as guarantee commission. They will be paid guarantee commission. That is an income for State Bank of India. And who is taking the guarantee? The government of Gujarat. So State Bank of India is the surety, government of Gujarat is the principal creditor, and Larsen & Toubro is the principal debtor. What is the contract? They have to complete the contract. So the contract may take 6 years. 6 years later, the road is completely laid and everything is pakka, quality cleared. Government of Gujarat is satisfied. All the departments, all the ministry level, they have get the clearance. Now, they will also give a discharge letter to State Bank of India specifically for this guarantee. The government of Gujarat will issue a letter. Believe me, it's so difficult to get it, but somebody in L&T, his only job will be guarantee. He'll be going and getting from government of Gujarat, he'll get a release letter. wherein the government of Gujarat will say, the performance promise has been performed. We are now hereby releasing. That immediately the State Bank of India will close. Then only the liability of State Bank of India will come to an end. Till then, the liability is there. Okay. I hope I'm giving you some examples which are very, very practical. But I'm giving this to you because this topic is not a dry topic for writing in the exam. This is an active topic. It is going to happen. Tomorrow, if you join the finance team of Larsen and Toubro, you could very well be responsible for guarantees. Then you should know what the basic law is and how it works. You cannot go there and say, Baba. You should know what it is. Okay. Somebody is asking, what is my name, meaning of my name? So I thought my name is not new to most people in India because the name that I have was the name of a famous cricketer, Krishnamachari Srikanth. So though he spelled his name with 2 Ks, I have only 1 K, and I'm not. My father's name is Sridharan and not Krishnamachari, so no connection. But then, and he's a Vaishnavite, I'm not, so a lot of differences. But the point here is, my name is actually one who can attract wealth, one who attracts Lakshmi or wealth. Kantam is magnet, one who can attract wealth. So to answer your question, I don't know if I have attracted wealth, but definitely one thing I've seen, when I am involved in any activity, wealth is attracted to that activity. Okay, that's something peculiar to me. When I'm there, to me, whether it comes or not, I don't know, but I can attract. When someone is signing as witness in loan agreements, are they implicitly dangerous? That's what I'm exactly saying. What witness? You are guaranteeing. Be careful. Never sign such things. Okay? What witness? Who witness? If you are a witness, then be clear. You put witness and then no. Yeah, witness is not giving a guarantee. Witness is not giving a guarantee. But tomorrow, in the court, when the case goes, anything can be told. He said he didn't sign as a witness, he signed as a guarantor. But yeah, but okay, to answer your question, if he is a pure witness in a loan agreement, pure witness, see, both the parties will sign. Opposite to the signature of the parties, they will say witness, and then 2 witnesses will sign. Witness is not guarantee. No, witness is not guarantee. But sometimes, in a pro note, somebody may be asked to sign on the pro note as a witness. This fellow foolishly will think he is a witness and he will sign it. The minute he signs it, he becomes a co-signatory and a guarantor. So be careful where you are signing. Better not to sign all these documents here. Better not take a risk, is what I would humbly suggest. This is more out of, once you become a member of the institute, you have to be very prudent. The financial affairs of the member of our institute should be above reproach. If a member of our institute is not financially prudent and seen as, not financially sound, people will start doubting our profession. They'll say, hey, you guys are saying you are good at finance and accounting and all. Your own member is not able to, he is becoming insolvent. Then what is the meaning of it? So in that spirit, we have to be very, then I cannot insist on that for all, but suggestion to you is have your financial affairs clean as a member of the institute, whether in service or in practice. Even if you are in service, you are a member of our institute. Because you are a GM in Larsen and Toubro doesn't mean you are not a member of our institute. You are continuing to be a member. You are responsible to maintain and uphold the fame of our institute wherever you go. Whichever role you play, you should ensure that the institute gets a good name. This is, no compromise on this. No, 100 more generations of chartered accountants can come. This cannot change. The respect you owe to the institute and the duty to maintain and uphold the name of the institute is non-compromisable. Okay? I have had 4 generations before me. I have 4 generations after me. This is a rule. Your institute ka reputation is important. Never let it go. Okay. A guarantee. Okay, now coming to continuing guarantee. These are specific guarantee. Now we are going to see continuing guarantee. Okay. Before I go there, maybe I think you are very tired from all this bombardment. We'll have a small break for 5 minutes break. 5 minutes break. And then I will continue with continuing guarantee. Okay. Sir, 5 minutes break, sir. Welcome back from a very short break because time is really running out and this is a huge topic, humongous topic. Therefore, I'm going to request you to bear with me. I just gave a biology break. So if you wanted to have a cup of tea, then maybe what you should do is bring it and keep it in your table and drink as you are listening to me, and eat your biscuits as you are listening to me. Okay. Now, we saw the specific guarantee. Now we'll talk about continuing guarantee. A guarantee which extends to a series of transactions is called a continuing guarantee. See, A is continuously supplying goods to B. Now C guarantees the payment of the amount due. Not for one sale, but for a continuous sale. So he says, you keep supplying goods to him. Whenever you supply, if he does not pay, I will pay. It's a continuing guarantee. So there will be a series of transactions. The essence of a continuing guarantee is that it applies not to a specific number of transactions, but to any number of transactions, and makes the surety liable for the unpaid balance at the end of the guarantee. So if everything goes well, see, A supplies to B, B pays, supply pay. No problem. But the guarantee will be like an umbrella hanging, protecting the principal creditor. But suppose A supplies, B does not pay. That's all. Once the liability is there, immediately the principal creditor can say, look here, I gave him, as you told, I gave him 60 days credit. 60 days over. Fellow has not paid. You pay me. Anytime. Any date it can be invoked. Okay. So at any time, if there is unpaid balance, I can ask. If it is overdue. See, if the guarantee says A should give 60 days credit to B, then A should be giving 60 days credit. On the 61st day, if B has not paid, then the guarantee can be invoked. So this is again, it's good for commercial transactions, right? Instead of, suppose there's a regular transactions between two people, you should not have to prepare a contract every time for everything. So they give one blanket guarantee and they say within this blanket guarantee, if anything was. So the liability of the surety continues till the performance or the discharge of all the transactions entered into. Is there or the guarantee is withdrawn? Who can withdraw the guarantee? In this case, the surety can withdraw, but not for old transactions. Past transactions, no. If already completed transaction, liability is there, I cannot deny that. But future transactions, I can revoke. So, specific guarantee cannot be revoked or withdrawn, but continuing guarantee may be withdrawn or revoked with respect to future transactions. Series of transactions means, like I gave an example, see, I may be lending money to A, may be lending money to B continuously. So every time you lend, it is a transaction. So there may be 5 transactions like this. It's a series of transactions. So instead of guaranteeing only one transaction, I'm guaranteeing many transactions. Series means coming one after the other. Transactions which are occurring one after the other continuously. So instead of guaranteeing them individually, I'm giving a blanket guarantee. Whatever goods supplied to so and so, up to so and so limit or whatever, I am guaranteeing. So the transactions will be happening continuously, series, one after the other. Finally, in case there is a default, whatever is the amount due have to be paid by the guarantor. Point to be noted, a continuing guarantee may be revoked by the surety with respect to future transactions. Any transaction already occurred cannot be withdrawn. Now let's look at this. A guarantees payment to B, a tea dealer, to the amount of rupees 10,000 for any tea he may from time to time supply to C. Hey, this is not chai. This is actual tea, bales of tea, original tea, raw tea, which is being supplied to C. Okay. B is a tea dealer. Okay. So B is supplying tea to C. And A says, I guarantee the payment up to 1 lakh. So A is guaranteeing up to 10,000, right? You can limit yourself. For any T, he may supply from time to time. That is what it means by series of transactions. Any T that may be supplied from time to time. So we are not talking about one transaction. We are talking about a series of transactions continuously happening one after the other. And up to 10,000 rupees, A is promising to compensate to B in case C does not pay. So B keeps supplying C with T up to the value of 10,000. C pays B for it. Then another next transaction. B supplies C with the T to the value of 18,000. Second transaction in the series. C fails to pay. Now, is C liable to meet this commitment? Yes, but only to the extent of 10,000 rupees. Only to the extent of 10,000 rupees. Because his limit is 10,000. Beyond 10,000, he need not pay. Suppose with this, no more liability. Once he pays 10,000, over. Okay. To the extent of 10,000. Absolutely correct. Okay. One question is asked by Ayush Agarwal. Let me anyway take it up. Practical question. Housing loan guarantor. Yeah. Any major person, 18 in India, majority is age of 18. After 18, anybody can be a guarantor. There is no minimum age of 24, 25. To my knowledge, no. To my knowledge, I have not seen this. 18 years and above. But suppose a person who is 23 years old wants to give a guarantee, tell me who will accept that guarantee. Unless that person is wealthy. Suppose the 22-year fellow is a startup entrepreneur, he's worth $1 million. I'll take his guarantee, yeah. I'll take his guarantee. But otherwise, so it's age of majority plus financial worth. To become a guarantor, you should have some financial worth. Only then it's, if himself is not worth anything, what is going to give guarantee to another person? So to give a guarantee, it's not about age. It's enough if you are 18 years. But financial worth of the guarantor is very, very important. Especially if you are giving a guarantee to LIC or bank or a housing finance company, they will want to have net worth certificate of the guarantor. Who is the guarantor? What is? So if the guarantor is having worth assets in his name and income, no problem. Enjoy. Give guarantee. Don't give guarantee. Never give guarantee. This is the core learning you're going to take out of this session. You learn the law, you will write the exam, you will clear the exam here. That is not the essence here. If you think Srikanth's lectures are meant to help you merely to pass the exam, maybe you have not, you are not relating with me as many of you are doing. I think you have understood who I am now. Learning the subject, come on. Just have to have a little brain, you will become a chartered accountant. Going beyond that. Okay, another example from the institute exam itself. Manoj guarantees for Ranjan, a retail textile merchant, for an amount of rupees 1 lakh, for which Sharma, the supplier, may from time to time supply goods on credit basis to Ranjan during the next 3 months. Please understand, this is restricted. 3 months, 1 lakh. So, Sharma is the supplier, Ranjan is the principal debtor, he is receiving the goods. Sharma is the principal creditor. Manoj is the surety. First, get that clear. Before you answer the exam question, please get it clear. Who is the surety? Who is the principal debtor? Who is the principal creditor? Manoj is the surety. Ranjan is the principal debtor. Sharma is the supplier, principal creditor. Sharma will supply textile to Ranjan. For the next 3 months, whatever he supplies, up to 1 lakh, Manoj will stand surety. Please understand. So the whole thing is time bound, 3 months now. After 1 month, Manoj revokes the guarantee. Now, this is a continuing guarantee or a specific guarantee? This is a continuing guarantee because he is giving a guarantee for goods supplied from the minute you see time to time, it's a continuing guarantee, series of transactions. Time to time. Again and again, but 3 months. So after 1 month, Manoj, the surety, revokes the guarantee. when Sharma had supplied goods on credit for rupees 40,000. So within that first month, Sharma has supplied goods up to 40,000 rupees. Now Manoj is revoking the guarantee. Is Manoj discharged from all the liabilities to Sharma for any subsequent credit supply? What would be your answer in case Ranjan makes default in paying back to Sharma for the goods already supplied on credit, that is for 40,000? I'm sure the answer is very simple. Quickly. Ayush, he is liable to the extent of 10,000, even on a specific guarantee. To the extent of his liability, he is liable. Yeah. To the extent of the 10,000 liability, he is liable. Beyond that, he is not liable. Okay. Okay. 18,000 supplied. That's okay. That is between them. My guarantee is for 10,000. I am not saying if you supply for more than 10,000, I will. That is not correct. That is not correct. You supplied tea to him. Value of 10,000, I will pay. Beyond that, I won't. That's all. Okay. But for continuing guarantee, what happens now? A continuing guarantee may be, see, you should write this in the exam. When you're writing the answer, you should write a continuing guarantee may be revoked with respect to future transactions. So any supply made by Sharma after 1 month, after Manoj has revoked, Manoj is not liable. But before he revoked any supply made, if there is any liability, Manoj is liable. So Mr. Manoj is discharged from all the liabilities to Sharma for any subsequent credit supply after discharge, after revoking the guarantee. But goods already supplied, if there is a default, where Ranjan makes a default in paying back Sharma for the goods already supplied, to that extent, Manoj is liable. This is the answer. Okay. Correct. Yeah. So in the exam, when you're writing, please write, a continuing guarantee may be revoked with respect to future transactions. Therefore, Manoj is discharged from all the liabilities for any subsequent. If you want, you can underline subsequent. In the exam hall, when you're writing the exam, when you think some word is important, you can write it in caps or in underline. Only you cannot use different colored inks, but you can underline. You can use capital letters to highlight it so that examiner knows subsequent is important. He has understood. For goods already supplied, if there is a default, he is liable. Again, Akash Neil, when you are using that word, one small suggestion. 40,000, that was, instead of just saying supplied, you can say already supplied. Because that word is used in the question also. Already supplied. Okay. Now, two people may become joint surety. Two people may make joint surety. That is, A and B together are becoming surety for one amount. Now, now normally for co-sureties, the liability is equal. Example, A lends 3 lakhs to B. A lends 3 lakhs to B. C and D are common sureties. C and D are common sureties. A lends 3 lakhs to B. C and D are common joint surety. There is no contract between them as to how they will split it. Okay? It doesn't matter. Now, B has to pay 3 lakhs, right? He pays the interest and he pays 2 lakhs. But he defaults 1 lakh. He defaults 1 lakh. Now, C and D's surety guarantee will be invoked. Now, how they will pay? They will have to bear it equally. Okay, but remember, liability of sureties is like that of a partner. You know, partners can be jointly and severally sued. Like that, surety can be sued. If there is no restriction of liability, then you can sue both of them or either of them or whatever. Okay. So, liability of two persons primarily liable as sureties is not affected by arrangement between them that one shall be surety on others' default. Nothing. For example, C and D here, there is an understanding that in case one of them becomes insolvent or cannot pay, then the other will be the surety. Okay. That doesn't matter at all. The principal creditor can file a suit against both of them. Okay. This is section 132. A and B make a joint and several promissory note to C. Joint and several, very, very important. Which means what? The minute you see joint and several, be careful. They are jointly liable and severally liable. That means what? They are liable together and also individually. Joint, don't ask. Immediately don't put the question, sir, what is joint and several? I am explaining it. Joint and several means they are liable together and several separately, individually. So C can proceed against both or only against A or only against B. Suppose A makes good the promise, then he can collect it from B. But C can sue anyone for the entire amount. Okay. C can file a suit against anyone for the entire amount. Then between them it is not, without any arrangement between them, it is equal. Okay. In fact, final point you'll see in this topic is co-sureties, liability of co-sureties. Okay. Here what we are trying to say is they can have a guarantee understanding between them. But as far as the principal creditor is concerned, he can file a suit against both. Now A makes it in fact as surety for B. So A pays his share and for B also as a surety. C knows that A is the surety for B, but it will not remove the liability of B. C can sue B also. The fact that A, to the knowledge of C, made the note a surety for B is no answer to a suit by C against A upon the note. Okay, he has to pay fully. Stop. C, A cannot say, look here, I am the surety of B. First you file a suit against B. If B defaults, then only I will pay. No. If there is a default by the original principal debtor, then both A and B are jointly liable. They are severally liable. So C can file a suit against B or he can file a suit against A. Now when he files a suit against A, what A says, I did not sign it as a guarantor. I didn't sign it as your guarantor. I signed it as a guarantor for B. Now, you knew about it at that time. Now. But C will say, no, I don't care. You signed now. So you are also a surety. You pay. You collect from B. That is your, but you pay me. This is the sum and substance of this example. Okay. See, why did Macaulay introduce this section? Possibly because there were frequent cases where one surety comes and says, I didn't sign it as a surety. I signed it as a guarantor for the other surety. No, Macaulay says, bullshit. If you signed it as a surety for him, that's your problem. You signed on the promissory note, right? You signed on the document, right? You are a party to the guarantee, right? Then you are a surety, co-surety, and you are liable. Again, I'm explaining the word joint and several. Similar to Partnership Act, the partners of a firm are jointly and severally liable to the creditors. Means the creditor can sue any one partner for the entire debts of the firm. One partner can be sued for the entire debts. He doesn't have to bother about how they are sharing and all that. Once the partner settles it, then he can file a suit against the other partners, or he can join the other partners and say, they have to pay me my share. That's okay. That's between them. But as far as the third party is concerned, he can file a suit against any one of them. So there are two sureties. They are jointly and severally liable. The principal creditor can file a suit against any one of them for the entire amount. That is what jointly and severally means. They are jointly liable and also individually liable. So you can file it. Then between them, they are jointly liable now. Therefore, the man who paid can claim to be compensated by the man. That is between them. The third party has nothing to do with this. That is what you have to understand. We come to another important topic. Discharge of surety. Possibly this entire explanation I have given about parties to the contract, liability and all is meant to help you to understand discharge of surety. Discharge of surety is, from the exam point of view, very, very important. Regular questions come here. Sneha Gupta says no. For what? Is it possible that there is a surety on surety? That is exactly the point, sir. There can be a surety on surety, but such relationships will not affect the principal creditor. Okay, that is the point. There can be a surety of surety. See, one surety can be a guarantor for another surety and all. But that is between you. As far as the principal creditor is concerned, when there are two sureties, both are liable. But surety for a surety, no. I have not seen it. That is surety himself. There can be another surety for a surety. I have not seen it. But though it's not legally impossible, it will become complicated. Multiple liabilities, etc. When will the second level surety, when his liability will come on this first level surety does not pay? Commercially, if there is a valid reason for it, you can do. But I don't see, because it's becoming unnecessarily costly. See, A is guaranteeing. Now you want B to guarantee A's guarantee. Why would you want to do that? Better go to a good guarantor who is capable. Why are you getting guarantee for a guarantee? So, I'm unable to appreciate why you would want to do this. After all, the purpose of guarantee is you should not have any problem. Tomorrow, if there is any issue, you file a suit to collect the money, or you send a letter, he pays the money. Instead of going there, why you want one more guarantor for the guarantor? No need. Though legally you can, commercially I don't really see a validity. Yes. It's not out of topic, Raghavan. In a way, you are linking only because in a way, guarantee and guarantee sureties, liability of surety, liability of partners is similar. Though you have studied it, it's already finished in your CPT or whatever. That's why it's based. But yeah, to answer your question, sleeping dormant partner is also liable. Okay. Sleeping partner doesn't mean that you are not liable. You are liable. Okay. Your name is mentioned in the partnership deed, you are liable. Okay. Like joint and several. That's why, be careful while joining a partnership firm. Again, very dangerous. Whatever the other partner does, you will become liable. But there again, chartered account need not worry. But then be careful, because if you are a firm of CAs, every partner is bound for the acts of other partner. But be very careful. Of course, in our professional firms, there's a lot of trust and understanding, but in commercial cases, business associates, business clients, sometimes the partner will come, this fellow will trust him, then he will give him power of attorney, right to do whatever he wants. Fellow will go borrow money left, right, and center. He'll also have check signing facility. He will sign the checks, take the money, run away. Then the liability alone will be there, money will be gone. Then he will run away. This fellow will run away, not to be traced. Then the guy though he's a sleeping partner, he will be holding the baby and have to pay all the liabilities. Okay. Discharge of surety. Very important. Yeah, if partners are jointly and severally liable and one of it pays the liability, can he recover the liability legally? No, you are Mr. Bharat, joint and several. Why don't you give importance to that word and? With respect to third party, they are severally liable, but amongst themselves, they are jointly liable. And both. Okay. So you are trying to see, this is where you're what you're trying to do is not a good thing. You are arguing. You are saying, sir, they are severally liable. Then now, sir, third party can sue any one of them. That is what severally means. Once he settles, then joint liability is there now. Therefore, he can file a suit against the others and recover. Okay. So I hope your doubt is clarified. Okay. I'm answering the question very carefully, though I'm not very appreciative of the fact that you're arguing. See, when you argue, you should argue from strength, never argue from ignorance. So don't argue. See, in the class, you have come to learn. Okay, please learn. Bharat, have you got it? The word is joint and several. With respect to third party, liability is several. The third party can sue anyone for all. But between themselves, it is joint. So whoever is settled can sue the others and claim. This is so fundamentally a principle of law. It's surprising that you are not aware. I don't know whether you read it in Partnership Act, but the same principle applies here also in sureties. The surety who settles can definitely file a suit and recover. But going back to the bigger question that somebody was asking, after all these fellows have run away, after all these fellows are not capable of paying, how will he recover? There is a bigger practical question. But whether he can sue, he can. See, nothing wrong in filing a suit, because tomorrow you never know how this fellow's fortune will change. Tomorrow he may become a rich man, in which case, he's got money, you can recover. So better file a suit and keep it. Even though today he is not capable, tomorrow he may marry a rich girl and he may become rich. So you can to save her husband's shame, that lady might pay you. So better keep it open, is the only point. Okay, nothing wrong in what you did, Bharat, but sometimes when you think too much in the exam hall, you might read the question wrongly. That is why I am worried for you. Be careful. Okay. In the exam hall, some students will do too much thinking. Like this, like that, like this, like that. Then finally, simple question, they will misunderstand, write the wrong answer and come. Whereas question could be fairly simple. If you know the law, see, institute questions, especially application oriented, they only want you to apply the law to the facts. Straight away. If you know the law, you can apply to the fact, you will write the answer. Only come to the final level, we'll try to catch you. We'll try to give you some confusion. Here at this level, we only want to know if you know the law and given a practical situation, can you apply it? So understand the law well, read the question correctly, understand the facts of the question, see how the law is applicable to it, write it. That's all. If it is an MCQ, read the question, see which is the correct answer first. Don't read all the 4 options. Use your brain and arrive at the correct answer. Then check the answers. It will be tempting to read the answers, because once you read the answer, you will hit that, hey, this is the correct answer. Then your mind will start forcing you to go there. No, don't. If you can possibly cover the answer, cover it. Read the question like a normal question. Think of the correct answer as if it is a normal question. Then read the options. You can come out faster. It's only when you waste your time reading the options, you will get locked. You get that? You get the approach I'm giving here? Do not read the options. Read the question. If it's a straightforward question, okay. But if it is a problem-oriented question with a multiple choice, don't read the choices. Do it yourself. Arrive at the answer. Then and only then read the 4 options. Suddenly you will find you won't be wasting your time. The correct answer will just strike you in the face. But then be a little careful. Read the other 2, maybe some small nuances there, but by and large you will get it right. When you waste your time reading all the 4 options, you will get confused. You will choose. So your mind will get caught with one option. Then your mind will not let it go. Rarely people are willing to accept that they are wrong. And once you decided, no, there is a correct answer, you will bullshit yourself into coming to the conclusion that there is a correct answer. Whereas read the question, write the answer, or make a note of your correct approach, and then only read the 4 options. This is a suggestion, not a. I know you are all highly intelligent. You don't have to do what I say. But if you do, the chances are you will get more marks. That's all. By revocation, discharge is by revocation. Revocation only for continuing guarantee. Be careful. A specific guarantee cannot be revoked. Okay. Modes of discharge: by the conduct of the creditor. Okay. By the invalidation of the contract of guarantee. Something is done by which the guarantee becomes invalid, or invalidation by the principal creditor or the principal debtor. Please understand. Okay. The conduct of the creditor is very, very important. When we come to, this is where most complicated questions will come only from here. I thought I could complete this, but I don't think it's going to happen. Anyway, let's see. Please note, revocation is possible only for continuing guarantee. We already saw that. Revocation can happen only for a continuing guarantee. Surety's death, again, will not revoke existing obligation. Only a continuing obligation to the extent of future transactions will be revoked. Continuing guarantee will be revoked only with respect to future transactions. Where already some transactions have occurred, death of surety will not revoke the old amount. But on death of surety, the contract will come to an end. Future transactions, no. But already, see, for example, A gives a continuing guarantee. Supply of goods for 6 months. Goods are supplied, paid. Then 70,000 rupees due. Continuing guarantee. Okay, 70,000 rupees due. A dies. Now, the guarantee will come to an end with respect to future transactions. But with respect to that 70,000 rupees, liability continues. Now you will ask me, who will pay, sir? Surety is dead. No problem. Physically he is dead. The body is burnt or buried. But money is there, na? His whatever assets he had in his lifetime will now become estate. Whatever assets the surety had, bank balance, shares, mutual funds, immovable property, vehicle, jewelry, everything will now become the surety's estate. It will be managed by the legal heir. The legal heir will become now the responsible for the estate. Before the legal heirs can distribute the assets amongst themselves, they have to settle all the liabilities of the deceased person. This is called estate. Okay, estate. The word estate, don't think tea estate or coffee estate. Estate means the any assets owned by a person on his death will become estate. Any asset, bank balance, FD, anything. Mr. A's mother died. She had 4 FDs for 25 lakhs each. So 1 crore. That is the estate of Mr. Mother of A. Now A is the legal heir, he can take it. But suppose that mother had given a guarantee for the sister. There is a sister for her 50 lakhs. Then that liability will still be there. And that 50 lakhs has to be paid. Only balance 50 lakhs our man can take. So surety's estate remains liable for the past transactions. I hope you understood what is the meaning of estate. Okay. Many words in English have different meanings. The word estate means property. Actually, the word estate means properties. Properties owned are called estate. So happens in those days in England, people had huge tracts of land in Suffolk or in Sheffield. And so that is my estate. So that word became thing where later on estate became common for tea or big land, stretches of land became estates. Yeah. Surety's estate is liable for past transactions. Yeah, why should you give a public notice for revocation, sir? It is enough if you give the notice to the principal creditor. Why are you giving public notices? Have you given the guarantee to the whole world? Or have you given the guarantee to the principal creditor? You are given only to the principal creditor, right? Then give it only to the... In fact, you need not even serve a notice on the principal debtor, except for information. Because after all, once you send the revocation notice to the principal creditor, the creditor will in turn run to the debtor and say, hey, look here, from now on, there is no guarantee. Man has revoked it. So that is up to him. So what do you think, Mr. Hitesh Jain? Should he give a public notice, or is it enough if you give a notice to the principal creditor? When you will give public notice, only when unknown third parties may be affected by your action. In this case, that is absolutely not there. No? Who is the only man affected by the revocation? Yeah, the principal creditor. To him, it is if you give a notice in writing, it is. Ideally, put it in writing. Why? Because suppose you phone up and tell him, tomorrow he will say, when did you phone? I didn't know. So better put it in writing, get his acknowledgement, close. That's all. Okay. Now, novation. Novation is the term that you learnt in Contract Act 62. Do you remember? That is, what is novation basically? A new contract is substituted. The old contract is substituted with the new contract. So the original contract is discharged if a fresh contract is entered into either between the same parties or between other parties. Okay. This is called novation. Right? Novation. So automatically when there is a principle of law is laid down in 62, you don't have to, not in this chapter. It is there. Okay. Where there is a novation, the old contract is discharged. Okay. Variance in terms of contract. This is a very, very ticklish topic. You have to be very, very careful in understanding it. Where there is any variance in the terms of contract between principal debtor and creditor, see, I have highlighted it this so that you have to put it in your brain, please. Where there is any variance in the terms of contract between the principal debtor and creditor without surety's consent, it would discharge the surety in respect of all transactions taking place subsequent to such variance. Subsequent to such variance. Now, this Anirudhan versus Thamko's Bank, I am giving it so that one exception is there. Variation which is not substantial or material, or which is beneficial to the surety, will not discharge him from his liability. Please underline the word beneficial to the surety. It should not be beneficial to the principal debtor. It should be beneficial to the surety. Giving time to the principal debtor for payment is not beneficial to the surety. Giving time for principal debtor for payment is not beneficial to the surety. It is beneficial to the principal debtor only. If it's a variance in term, it will discharge the surety. Got it? So, I'll give a simple example. Very simple example. A is supplying goods to B. A is supplying goods to B. Terms of credit 60 days. Terms of credit 60 days. On 60th day, on or before 60th day, payment should be made. That was understanding. Goods are supplied. 60 days payment is coming. Now suddenly these fellows, what they do, A tells B, hey, you pay within 90 days, I have no problem. He is extending the date from 60 to 90 without surety's consent. That is a variation. So goods is supplied up to the date, it's a 60-day contract, no problem. But once that the credit term is now extended to 90 days, any supply made would not be bound. The surety is not bound, because the minute you make a variance in the terms of contract without surety's consent, there is a discharge. Okay, how to do it correctly then? Call the surety, tell him, boss, we are now going to increase it to 90 days. Are you okay? Surety says, hello, okay. Then he gives his consent. No problem. Go on. So that the crux, the crucial issue is variance in the terms of contract without surety's consent. Okay. In the exam problem, if you don't apply this point, it will be you'll be in difficulty. Similarly, see, this 90 days time being given is not beneficial to the surety. It is beneficial to the principal debtor. The variance is not beneficial to the surety. Okay, suppose there can be some variation which could be very not substantial at all, or immaterial, small things could be there. For example, I'll tell you. Supply of goods should, I'm giving an example. Supply of goods should be made to go down. That was understanding. Now they are varying the contract in such a way that supply of goods should be made to the shop. Is this a substantial variation? Nothing, yeah. Goods are still being supplied. Liability is still there. There is no principal debtor liability is still very much there. Only the location of the supply is changed from go down to shop. So it's not substantial or material. Of course, it's not beneficial to surety, not affecting the surety also. Because where you supply, how does it matter? So long as goods are supplied, proof is there. That's all. C agrees to appoint B as his clerk to sell goods at a yearly salary. Upon A is becoming surety to C for B's duly accounting for monies received by him as such clerk. That is, C is appointing B, the clerk, yearly salary, provided A will be the surety. Possibly A is uncle of C and uncle of B. So C says, hey, ask your uncle to give a guarantee, man. So B goes to his uncle and he says, Uncle G, please give him a guarantee. So A says, whatever, my nephew will take good care of your money. In case he is any defalcation, I will make good. So now A is the guarantor for B, C is the principal, A is the surety, B is the principal debtor, C is the principal creditor. Always prepare this chart. Who is the principal creditor? Who is the principal debtor? Who is the surety? Then only start answering. Now, A has given, uncle has given, enjoying life. Now what happens? Without A's knowledge or consent, C and B agree that B should be paid by a commission on goods sold by him and not by a fixed salary. At the time of appointing him, salary. Now you are telling I'll pay commission and all. Subsequently, once this variation happens, if there is any misconduct by B, A is not liable. Because it's a variation in the terms of contract Okay, without the consent of the knowledge or consent of the surety. See, first there should be knowledge, only then consent. So if it is without consent, it is automatically without knowledge. Sometimes it could be that, it is possible that he may have knowledge but not consent. Sometimes consent could be the knowledge. For example, girl wants to marry a boy. Father is aware of it but not allowing. So he has knowledge but no consent. Right? Sometimes both knowledge and consent will not be there. One fine morning he finds girl is not there. Run away. That is also possible. Okay. So I'm just giving an example, not to be taken otherwise. While you are there on Merchant of Venice, this also happens to Shylock. His daughter Jessica, she runs away. At the end of the play, Shylock is left without money, without daughter, because they steal all his jewelry and run away. Jessica and her lover, they run away. Graciano, they run away with all the money. In fact, in the Merchant of Venice, Shylock is not exactly the villain, actually. Nowadays, the reading of Merchant of Venice is done in such a way that Shylock and Antonio is not the hero. Actually, Shylock is the victim of the piece, and he is the man who suffers. Post-Holocaust, the Jews, we have understood the Jews, how they were, how the whole, Europe, they were insulted and all. So today, shall we say, pro-Semitic reading of Merchant of Venice, Shylock is actually a victim rather than a villain. Anyway, so C contracts to lend B 5,000 rupees on 1st March. A guarantees repayment. C pays the 5,000 rupees to B on the 1st January. See, what did you say? That you will lend on 1st March. Now he goes and rents on 1st January. Variation in the terms of contract. Discharge. Because my liability will begin only on 1st March. Who told you to lend him on January? So, now what happens? C can sue B before the 1st of March. So my liability is not there, boss. You should have lent on the 1st March when I told you to that. If you lent on 1st January, discharge. This discharge of surety is a very, very ticklish topic. We have to be very, very careful. We will maybe finish this problem and then we'll go. Chetan was appointed as site manager of ABC Constructions Company on a 2 years contract at a monthly salary of 50,000 rupees. Mr. Pawan gave a surety in respect of Chetan's conduct. After 6 months, the company was not in a position to pay 50,000 to Mr. Chetan because of financial constraints. Chetan agreed for lower salary. This was not communicated to Pawan. Underline that, very important. Pawan is the surety. Chetan is the principal debtor. Okay, ABC Constructions Company is the principal creditor. They are now saying, I'll pay you less than the salary agreed. Variation in terms of contract. Not communicated. 3 months afterwards, it was discovered that Chetan had been doing fraud since the time of his appointment. What is the liability of Pawan? During the whole duration. Be careful. Till the date of variation, Pawan is liable. Any amount defalcated till the date of variation, Pawan is liable. After the date of variation, Pawan is not liable. Okay? Pawan is not liable. Got it? You can't answer the question by saying, you can't give one answer. Pawan is liable, Pawan is not liable. The correct answer is, till the date of variation, Pawan is liable. After the date of variation, in the contract, without giving him notice, or without communicating to Pawan, Pawan is not liable. Okay? Which is why, setting MCQ questions for this type is very difficult. And once you give the answer, now immediately the student will know what is the correct answer. So very difficult to disguise the answer also. Okay, give me 5 minutes to complete this topic also. It's very interesting. Conduct of the creditor. See, where here you had a variation. A was variance in the terms of contract. B is release or discharge of principal. See, suppose the surety discharges the principal debtor. He enters into a fresh contract with the principal debtor by which the principal debtor is released. Or he does something which is an omission, the legal consequence of which is the discharge of the principal debtor. In any way, if you discharge the principal debtor from his liability, the surety is released. The principal creditor should behave in such a way that the surety's rights are protected. Discharging the principal debtor not allowed. So A gives guarantee to C for goods to be supplied by C to B. C supplies goods to B. Afterwards, B contracts with his creditors. B is the principal debtor. He makes a contract or arrangement with his creditors, including C, to assign to them his property in consideration for their releasing him from their demands. So B feels that he's going to become insolvent. Instead, he calls all his creditors, including C, tells them, boss, I can't pay, but here is my property, take it. Whatever amount you owe, you cancel it. They agree. They take the property. Now B is released from his debt, but without knowledge or consent of A. So A is discharged from his surety share. Now, suppose the property is sold subsequently and the amount released is less. Now, fellow B, C cannot come and tell A, you guaranteed 5 crore. We sold the property. We got only 3 crore, 2 crore you pay. No, sir. Did I tell you to accept the property? You should have sued him. Then my right should be there. I would have gone there. Why are you waiting? Why did you give him that opportunity? So since you have released or discharged the principal debtor, the surety is discharged. It's very interesting area. In the next class, see, your answer is a little dangerous. No, who is liable for fraud? Basically, Chetan is liable for fraud. Pawan can never be made liable for fraud. Please understand. Pawan cannot be made liable for fraud. Pawan is liable to compensate the company for any loss incurred due to Chetan's fraud. Got it, Hitesh? You have to be very careful in law. Okay? If you write this answer in the exam, you will not get marks. And you are a highly intelligent student and you will ask, why you have not got marks? Because Pawan is never going to be liable for fraud. Because he didn't commit the fraud. But as a surety, he has to compensate the company for loss incurred. Now, that liability of the surety to compensate the company will be there only till the date of variance. Any transaction beyond that, any defalcation beyond that, Mr. Pawan is not liable to compensate. Okay. Good question. Yes. Conduct. No, see, actually, I made a mistake. Conduct of the creditor is a common term, common point. First is by variance of terms of contract. Second, by release or discharge. Okay. The section does not say consent or knowledge. So even with knowledge or consent, if you release it, you are discharged. Okay. Beautiful. Let us stop here. Next class, we will continue our deliberations. Right? Class over, sir.